Hey traders, and welcome back to Smart Risk. Supply and demand is one of the most powerful concepts in smart money trading. And if you trade gold, Bitcoin, or Eurodollar, mastering it can completely change the way you read the market. These zones reveal where institutions entered, where major moves began, and where price is most likely to react again. In this episode, I'll show you what supply and demand zones really are, how they form, and how to identify the highest quality areas on the chart. Then, we'll break down the complete trading model step by step and show you how to combine higher timeframe zones with lower timeframe confirmations to find A-plus setups, especially on gold and Bitcoin. We always appreciate your support, so make sure to give this video a thumbs up. And if you're new here, subscribe to the channel. See you after the intro. Welcome back, traders, so let's get started. Supply and demand is one of the most important concepts in smart money trading. Every trader needs to understand it because these zones are a major foundation of price action. Many of you ask, what strategy works best for gold, Eurodollar, Bitcoin, or other major markets? The answer is simple: supply and demand. Especially in volatile markets like gold and Bitcoin, price often reacts strongly around these zones. If you do not include them in your trading model, these markets can quickly expose weak entries and wipe out your capital. Let's start with the basics. In a bullish scenario, when price pauses and then breaks a major high with a strong impulsive move, it leaves behind an unmitigated demand zone at the origin of that move. Similarly, in a bearish scenario, when price pauses and then breaks a major low with strong momentum, it creates an unmitigated supply zone. So, supply and demand zones are essentially the areas from which price launches an impulsive move that causes a break of structure. However, the pause before the breakout is just as important as the breakout itself. This is the quiet phase where price consolidates within a narrow range, builds liquidity, and prepares for the next major delivery. Once enough liquidity is gathered and smart money enters the market, the real move begins. Another important tip is to pay attention to how long price remains inside the consolidation. In many cases, a well-formed pause followed by a strong breakout can create a higher quality supply or demand zone, increasing the probability that price will react when it returns to that area. To identify supply and demand zones correctly, focus on the origin of the impulsive move that caused the break of structure. This is the exact area where price aggressively moved away. In a bullish scenario, the final down close candle, or a series of consecutive down close candles, at the origin of the bullish impulse represents the demand zone. These candles usually form inside or immediately after the accumulation phase. For example, in this case, the last two consecutive down close candles formed after a temporary pause and before the expansion move. Together, they create an unmitigated demand zone. Here, we have another demand zone formed by these three consecutive down close candles. They appeared after a short accumulation phase at the origin of the impulsive move that broke the previous high. The same principle applies in a bearish scenario. The final up-close candle, or a series of consecutive up-close candles, at the origin of the bearish expansion represents the supply zone. These candles also form inside or directly after the accumulation phase. The time frame you use to identify supply and demand zones is extremely important, especially when trading volatile markets like gold, Bitcoin, and Eurodollar. If you trade every zone that forms on every time frame, you will most likely end up taking too many low-quality setups. That is why choosing the right time frame combination is crucial. Supply and demand zones on the 4-hour and 1-hour charts are generally more reliable and more likely to be respected. My preferred combination is the 4-hour chart for market analysis and identifying high-quality zones, and the 15-minute chart for confirmation and entry models. You can also use the 1-hour and 5-minute combination, but you need to be more cautious. Here is another important tip. When price first touches a supply or demand zone, do not trade every minor reaction. If most of the zone remains unmitigated, price may push deeper to fill the remaining orders before reversing. Entering too early can make you liquidity for traders positioned at better prices. So, wait for price to mitigate at least 30% of the zone